We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is new guest to the show, Arnold Villeneuve, author of Private Placement Profits. How are you today, Arnold?
I'm fine, Tom. Thank you very much. And thank you for this opportunity to be on your show. As you know, I'm a big fan of the show, and it's on my subscriber list. So I hope if any of your listeners are catching this for the first time, I hope they'll subscribe as well, because I've got a lot of value out of it.
Well, I appreciate that, Arnold. And maybe to let you know and to let our listeners know, we have a new Facebook page that you guys can all go check out, Palisades Gold Radio, and we'll hopefully serve to facilitate more discussion and just another avenue for our listeners to interact there too. So why don't we start, Arnold, by having you tell us a little bit about your background and how you kind of came to be interested in this topic?
Yeah, so I guess back in, I studied photojournalism out of college, and I was a journalist in Toronto for a year. And then I just decided I didn't like asking stupid questions all the time. Like, how does it feel to lose an election? So I wanted to move into something else. I did recording arts. I actually studied for 2 years at Trebas, and I toured with a band and managed a children's artist and a jazz artist. But then I realized there's no money in the music business unless you're willing to sell your soul. And even then, I think the key was when our bar tab at night was more money than we were getting paid to perform. That was kind of the dead giveaway signal, So I lucked into computers all of a sudden, and I wanted to be a developer. And so I started trying to learn how to program, and I was in a 9-month program at Ryerson. And after 3 months, the professor came to me and said, Arnold, it's not too late to get your money back, which goes to recognize what you're not good at, But I knew I loved computers, and I was very good at putting them together and taking them apart. And back then in the 80s, 82, I was there when MS-DOS version 1.0 was released. I mean, there was a lot of, moving parts to put computers together and get them to talk to each other. So I've done computing for 30 years now, and I've been a mercenary on my own in the IT business. I've authored books for McGraw-Hill. I've authored 6 courses for Learning Tree International. And I've been focused on IT consulting, and I've worked through all the different platforms that are out there. And currently I'm a certified Microsoft Azure, Google Cloud, and Amazon professional architect. I'm also a certified instructor for those technologies. And I'm part of a 10-partner consulting firm called Troposphere, where that's what we do. That's my main gig, basically. And I have a background in data analytics and in analysis, both of unstructured text and of structured data and of numbers. I actually teach Power BI and the Power Platform for Microsoft, and I help clients implement those technologies. So that's my background, essentially. I'm a pilot. I flew a bush plane for 20 years throughout Northern Ontario and Quebec. And I've got 2 rescue Dachshunds that keep me busy.
Excellent. So you're kind of telling me before the call that your teaching background is very helpful to try to, translate this message that you're trying to bring across, which is the power of private placements. So tell us how your teaching background plays into how you wrote the book.
Yeah, so it goes back to, again, my journalistic background, and how you write an article for a newspaper is very, very different than how you would write, say, a white paper on the same topic, right? Very different structures in the way you structure things. And as what teaching has taught me over time is how to take very complex topics that people are new to and find a way to get them to compare the new technology with something they know already. Okay, because if you can use that analogy, oh, that new thing works like this old thing. It helps us bridge the gap to understand better what this new thing is. And so I've become very adept through the authoring of courses to be able to take a complex topic and try to find a way to convey it in a simplified way. And some of the technologies I teach are very complex and very new, very new. So I myself, in many cases, have to first learn about them, which is always the best way. You know, you learn about something, you're then in a better position to teach somebody about it. And as you teach people about that technology, you actually, as the instructor, you learn more about it as well, because they bring their questions to the table, which are questions you would never think about. So in the writing of this book, I actually enlisted two of my buddies to participate in private placements. So as they were going through their experience, they would share it with me so I could see what was difficult or easy for them and incorporate that in my understanding of how I worked with private placements and tried to, find them, research them, and benefit from them. So storytelling is certainly the best way to convey something. And so when I write, I like to pretend I'm sitting with you and I'm trying to tell you we're sitting, for a beer at the picnic table out in the backyard. And I'm trying to tell you, well, hey, I discovered this thing. This is what it is. This is kind of how it works. And this is what I did to implement it. And these were my results. And so I take you on my journey effectively. And that's what I've done in the book. I've tried to share with people my journey of discovery of private placements, what they are, how you can participate in them, how you can benefit them, and just walking you through the process. I actually show you my own documents. In the book, I show you my DSR statements, my DRS statements, the direct registration statement. I show you a copy of what it looks like. I show you a copy of what a trade looks like when you get, the results of it. And I show you where to find the information. So it's literally just me sharing my story with people on this investment instrument that is not very well known, partially because of the way it's marketed. It's marketed to a very exclusive group of people, which is why I have the subtitle, this investment in vehicle for the rich, famous, and well-connected, because it's oftentimes by the time you or I would ever get to hear about these private placements, they're already full. We normally only get notified of the private placement when the deal is already done. It's a fait accompli, as we say. But that doesn't have to be the case. You can actually be more proactive, especially if you have identified a company that you want to invest in. You've already done your research. You've decided that, that they've got a good narrative and a good story or a good asset, and I want to invest in them. So you've already decided to invest in them. Why not find out if they are going to offer a private placement? Because there are benefits that go with the private placement, and you still end up with the same shares that you would have on the open market. So I try to always take what I learn, and even when I don't plan on writing a book, when I'm researching something, I make copious notes. I make a lot of notes, which then helps me build that story. So and certainly testing it on people. That's why I enlisted some other people, because my experience would be just my unique experience. In fact, I actually hired a millennial because I'm 59, as I mentioned earlier, and I hired somebody who's 30 years old, and that not my kids, because they know daddy, right? They're going to have a bias, right? So I hired a kid that I know that plays in crypto. He's pretty good at crypto, so he understands investing and that kind of thing. And so I engaged him and I paid him $200, and he did a review and he gave me his perspective, and I made changes to the book as a result so that it would communicate better to a wider audience, So getting feedback during the process of writing is an important part of developing what I call a great learning experience. When students come to my courses, I want them to have a great learning experience. And when you've finished reading the book, I want you to be in a position where you could go, I know where to find the private placement. I know how to participate in it. I know how to ask for the offer. I know how to get on the president's list. I know how to process the paperwork. I know what documentation to keep track of, and I know when to execute my trades so that I can transfer my shares and warrants into my account. And then I took it a bit further because I'm not an investment guru. I wanted to certainly have a disciplined approach. I don't know when the top is going to be. And so I wanted a disciplined approach to hold shares in companies I believe in, but also slow but surely take profits as that company becomes successful, as the management answers the question for the reason for the private placement, as the story plays out. I don't want to wait till the top. I'm going to make less money, but one of my core principles is preservation of capital. I have a very small capital base, right? This is not my main investment. This is, I decided at one point to actually spend a little bit of time on it. So while I was learning myself what to do, my teaching background and my consulting background in particular has taught me the importance of documentation. And I've worked on so many IT projects. I mean, $1 million IT projects where the documentation is just pathetic or non-existent. So I insist on it with all my customers that when we do a project, there's going to be proper documentation. So it's natural for me when I'm doing something. I'm always taking notes. And several times I've taken that collection of notes, my story, what I've learned, and turned it into a book. And this is an example of that.
So let's get into some of the, let's say, the nitty gritty, the specifics of what you're talking about. Can you explain to those who aren't familiar with it, what is a private placement and why are they important in your eyes? And share with us your ice cream analogy.
Okay, so I think the first thing to tackle is the word private. Because the minute you hear the word private, you immediately think that I'm investing in a company, a private company, that only a few people have shares in. And suffice it to say, there are many types of private placements. You can invest in a small company. Let's say your brother starts up a company and he is, got a great idea or something, but he needs $10,000, to do his marketing or whatever. And he comes to you and says, will you buy some shares in my company? That's a form of a private placement, right? He has 100% of the shares and he's going to give you 10% for $10,000, but it's a privately held company. There's also real estate private placements where a developer needs to raise money to buy a piece of land so that they can build a condo building on. So they do what's called a private placement real estate offering to raise money specifically for that property and that building and that project. And again, it's a private investment in a privately held company that does not trade on a public stock exchange. And then we have private placements for public companies, which is basically the private placements I'm referring to in my book. I only invest in private placements of companies that are currently trading on a public exchange, such as the TSXV, the Vancouver Venture Exchange, the Toronto Venture Exchange, or the over-the-counter exchange, for example. And sometimes the companies on the TSX or the NASDAQ may offer a private placement as well, but they're fairly rare. So that's the first thing. What is a private placement? It's where you get to invest in a company and you get something in return. And what you get in return is what's called a special unit. And the special unit is comprised of one of the same stocks that trades on the open market and a warrant. And the warrant is basically a right for you to purchase a certain number of shares at an agreed upon price for a certain period of time in the future, either 1 year, 3 years, 5 years, for example. So if you consider the value of a warrant for a minute, if the company agrees to allow me to buy the shares at 10 cents and they're trading at 50 cents, that means immediately I've got this 40-cent difference here. I'm going to make money. So the warrants have a lot of upside potential for profit. So the ice cream analogy that I put together, and this goes back to the idea of telling a story, is so you know that I only invest in publicly traded companies. And so the analogy I put together is you come into my ice cream store, and I only have two products in my ice cream store. I have an ice cream cone, and I have the exact same ice cream cone with ice cream in it. Okay. And they're both 5 cents. And you look at me and you say, hey, man, what's the deal here? What's the catch? I say, look, this is what my boss told me to do. He said, today, these are the two products we're offering. We have an ice cream cone here, no ice cream, 5 cents. We have the exact same ice cream cone with ice cream, 5 cents. Which one would you like? So you buy the ice cream cone with the ice cream cone for 5 cents and you go away happy yet bewildered. You don't understand. And when I first stumbled across private placements, that was exactly the feeling I had. I had done my research. I had picked a particular company I wanted to invest in. And while I was, searching through the internet for more information about this particular company, which is trading on the Toronto Venture Exchange at 5 cents, interestingly enough, at the time. So the shares on the public exchange were 5 cents. And I came across an article, a press release that said this company is offering a private placement at 5 cents per special unit. And the special unit was one full share, one ice cream cone with one full warrant. And the warrant is the ice cream. And so I just said, well, wait a sec. Now I've got a problem here. I can buy the share of this company on the open market for 5 cents, or I can invest in this private placement and for 5 cents get a special unit package. And the package basically is the same share that trades on the open exchange for 5 cents and this warrant that gives me the right to purchase more shares in the future at an pre-agreed upon price, which in this case was 7 cents. So when I discovered that, I literally for 2 days, I scratched my head. I didn't understand. And so I did some further research and I found that company had offered their private placement on a website platform where you can go and you can actually learn about the private placement and you can actually sign up and subscribe. So I thought, well, this is interesting. So I went and I signed up. I filled out all the paperwork. I signed digitally. And then they told me where to send my $1,000 because that's all I was going to invest at this point. Like these for me were speculative investments that I wanted to start to play with. I'd started this in the spring of 2020, and in June 2020, I invested $1,000. I put $5,000 aside, and I invested $1,000 in this private placement. And so I got this paperwork that said, you now own 20,000 shares and 20,000 warrants. The 20,000 shares were at 5 cents. That's what I paid for the whole package. The special units were the exact same price as the open share was. Only with the private placement, I got this ice cream called the warrant. And I filled out the paperwork. I sent my money in. I got my DRS statement, which is a direct registration statement that says you own 20,000 shares in this company. And then I received a separate package from the company, which was my warrant certificate that basically outlined the warrant. So I put that in my filing cabinet, in my documentation. And I noted on the calendar when the expiry date was up, which was in this case was 1 year. And in May of 2021, I actually exercised the warrants when the shares were actually trading at 50 cents on the market. They had been as high as 84. They were trading at 50. So I sent the company $1,400 last May, and they sent me my 20,000 shares, which were worth 20,000 times 50 cents, right? And deposited that into my account. So that was an eye-opener for me. Had I just invested the $1,000 in the stock market, yeah, my shares would have gone up to 50 cents a piece. I'd have made money. But the fact that they offered that private placement and I was able to participate in it with the warrants gave me an upside potential that was phenomenally better than I could have ever gotten just by getting the stocks alone.
Made you almost double what your alpha would have been on that trade.
Oh, more so than that. I mean, when you think about it, if I invested $1,000 at 5 cents for 20,000 shares, I ended up with, and then another 1,400. So I invested $2,400 in total, right? $2,400 in total. And I ended up with 40,000 shares that are worth 50 cents a piece. It's like, that's a 10x. That's a 10x. Now, as part of the strategy in my book, the hold and exit strategy, I have sold 20,000 shares since then. No, I've sold 10,000. I'm sitting on 30,000 shares, which I now call keepers, because by selling 10,000 of the 40,000 shares eventually, I more than recouped my money. I recouped like $5,000. So I recouped my 2,400 plus another 2,600, plus I'm sitting on 30,000 worth of free shares that are currently valued at 50 cents a share. And I consider the company what I call a keeper because they actually discovered 3 wells of helium. They have 3 producing wells now, all in the space of 12 months. And they did a second private placement with the big boys, which I couldn't even participate in. And they raised enough money to build a helium processing plant. So they're going to be doing processing out of the ground to the finished product. Fantastic.
So,
and
Arnold, what has been the let's say traditional gatekeeper or barrier to entry for most people participating in private placements?
Yeah. So first off, you have to know they're happening. Okay. There's actually a great website I talk about in the book that they list out all the private placements as soon as they find out about them. They list them right away. But literally 90% of them are closed. The deal is done. They've already raised the money. So you have to know about these things. You can't be reactive, right? You have to be searching for these things, which comes back to, it's not about the private placement. The private placement's the worst reason to pick a company to invest in. You want to pick a company that's got solid fundamentals and as a good story and a good asset, and most of all, good management, right? And so you still need those things, but the barrier to the private placement is to participating in the private placement is that most people don't know what it is, number one. And even if you did, you're not on the list. You have to be on the list. So how do you get on the list? Well, Rick Rule and Marius Konechny are 2 people I follow. And one of the things they say is, well, pick up the phone and call management. Pick up the phone. If you're going to invest money in the company, this isn't Apple, right? You're not going to get to talk to the big people at Apple or the CEO at Microsoft. These are smaller companies that have some passionate people who are trying to build something they believe in most cases. And so I picked up the phone. I called management. I said, hey, I'm a small investor. I'm telling you that right now. I'm a small investor. I'm kind of interested. I have a couple of questions about the company. And by and large, everybody answered my questions. They all picked up the phone. They called me back. They answered my questions. And then I said, well, I've just finished participating in a private placement with one company. Are you going to be doing a private placement in the future? And in some cases, they'd say, no, but we can put you on what's called the president's list. What's the president's list? I said. I had no idea what this was. Well, companies, when they're starting up, they have what they call a president's list. And if they need to raise more money, they go to the people in the president's list. And a way they raise money is through a private placement. So all you have to do, like the man said, ask and you shall receive, right? And so just ask to get put on the president's list. And I'm honest with all of them. I say, look, I'm a small-time investor, small-time investor. I'd like to see if you're going to do a private placement and participate. And sure enough, I get emails. In fact, one company I want to invest in, they say, no, we're not doing one right now. We think we're well-funded, but they hit something which was very promising, and they wanted to expand the drilling program. So they needed to do another round. They needed to raise more money. So 6 months after I'd been talking to them, I got an email saying, Arnold, we're doing a private placement. How much would you like? And I had already started putting a little bit of money into the company. And then I got to participate in the private placement, which put me in a much better position. I like the company, and now I've got the benefit of the warrants, that if this company does go, those warrants are going to supersize my returns effectively is what they're going to do, like going to McDonald's, supersize me sort of thing. That's what that does to your return potential,
So what about the typical, difference between being an accredited investor, which is most private placements are geared towards, versus being non-accredited?
Yeah, so that was your question that I was supposed to get to. So the barrier, what are the barriers to people getting in here, right? Well, I read through the British Columbia Securities Commission regulations on private placements, and I've read through the one for the TSX as well and the OTC as well. Boring documents, absolutely boring documents.
I can't
And
imagine.
I actually wrote to the British Columbia Securities Commission with 4 questions, and I list the questions in the book, and in the appendix I put their reply. And it had to do specifically with, what are the barriers to participation in private placements? And the accredited investor they put together because they didn't want people who were ill-informed, had not done their research. I don't want to say uneducated, but they hadn't taken the time to educate themselves about the investment potential and equally the investment risk and the fact that they could lose all their money, right? So they didn't want to have to deal with a whole bunch of people griping over the fact they lost $1,000 or $100. So they limited it to what they called more sophisticated investors, which essentially means the sophisticated investor has a lot more education in investment principles and in investing and all that sort of stuff. And they have to have a certain amount of income. They have to have, jointly at least $200,000 a year in income, which for many families today, that have 2 working professionals, they're very well in that category. Or they have to have, a fair amount of money in the bank. But most accredited investors that could come in, that have the potential come in, that don't know anything about this, they just combined income has to be $200,000. If you do meet that yardstick, you're considered an accredited investor, and then you could participate legally in the program. And so most companies, just because they don't want to deal with, for lack of a better term, people who just haven't taken the time to do their research and don't understand that they could lose their money. And in fact, in the book, I stress, and I have the PONC promise that you sign in the book. It's a page in the book, and I want you to photocopy it and put it on the fridge. You do not invest money you cannot afford to lose. Mm-hmm. That is that's the core tenet. That is just no way. You just don't do that. So the people that are investing here have to be prepared to lose their money. Now, I mean, is it as dire as it sounds? No, all the companies work the same way, and some of them will be successful and a lot of them won't. As you well know, the statistics in the gold mining industry are very tough statistics. It takes a lot to discover a world-class producing gold mine. So some of them will fail. And I know some of the ones I have in my portfolio right now, I have 12 private placements in my portfolio. I know very well some of them will fail, but I also know it only takes one of them to make up for all the others. Mm-hmm. One knockout of the park is all it takes. And you've made up for a lot of these other mistakes that you've made. And if I could do, 6 of them actually make money, 6 of them lose entirely, but 6 of them kind of make money and 1 out of the 6 goes to the moon, I'll do okay. I'll do okay at it. And again, my capital base for this is very small. I started with 5,000. I've grown it now to, close to 100 in a year, or not quite a year, but a little bit more than a year actually. But that's all been through warrants. It's all been through the power of warrants, to be honest with you. So it's all doable, but there are risks. So the accredited investor was really to simplify things. And you know what? There's enough of them around. There's enough doctors, lawyers, professionals that have the money, that could invest in these things, which is why they're gone so quickly. Even the people who are on the president's list, if you get an email and you're not fast enough, you're on holidays or something and you come back 5 days later, sorry, buddy, they could have 1,000 accredited investors on their president's list, and maybe because of the size of the private placement, only half of them get to put money in, right? Because they wanted to raise 10 million, half the members put up the 10 million, it's done. So the unaccredited investor is anybody that doesn't meet accredited investor status, obviously. But you know what? For these private placements, they allow family members to invest. And what would be called insiders, right? People who are your relatives. They have a separate document for that, for the family members to sign so they can invest. and attest to the fact that they understand they could lose their money. There's a similar paper for unaccredited investors, but companies, generally speaking, don't tend to use it because they don't have to. There's enough money there already. So you got to fight for this. You got to get on the president's list. And when that company that you like or you've already invested in and comes up and offers a private placement, you got to be ready to pull the trigger in days and wire them your money, because you could sign the paperwork, but if you don't get your money in, first come, first serve, right? Now, sometimes they do over allotments. So I'm doing some research. I find the company. I see they're doing a private placement, and it was listed last week. So I call them up and I say, I see you just did a private placement. Is it closed? And what you have sometimes is say, yeah, it closed, but we got an oversubscription. So we asked and we were able to add 3 more million. So we still have some room. Would you like to participate? So just because you've seen a private placement in a company you like that has closed doesn't mean to say it's necessarily, final yet. So I always follow up. And I've had 2 hits with that. I've had 2 hits where it was closed for a week or 2. I called them up. They're doing an over allotment. I still got to participate. So you definitely have to be proactive. And again, it speaks to, I don't go hunting for private placements. I go hunting for companies first, and I make sure I'm in the queue for notification when a private placement comes up, if there's one not there yet. So, and that's how Arnold, I find out about them.
Arnold, as you're talking about the companies that you're trying to find, this kind of plays into your PONC, which is something you mentioned earlier, or your point of no concern investing strategy. So explain to us a little bit about that.
Yeah, the point of no concern is a term. I actually looked it up, and where I learned about it was from Rick Rule. He uses it quite often in his presentations. And the idea is, as you know, he invests in a lot of things. He's in a lot of private placements. And the point of no concern for me, the way I interpreted it is this. I buy some shares in a company. Let's say I spend $1,000. When the shares go up enough, I want to get my $1,000 back. So the only way I'm going to get my $1,000 back is if they at least double. So a rule I have is the shares have to at least double. And in these companies, we're not talking companies whose shares are $30 or $50 or $100. We're talking companies whose shares are under $1 or under $5 type of thing. So price fluctuation can happen quite quickly. I've seen the shares go from 5 cents to 50 cents to 5 cents over a matter of 6 months. It does happen. So when that happens, I want to be there to capture my point of no concern. I want to get my capital off the table as quickly as possible. Now, some people out there listening to the show would say, well, he's a warrant sniper. I just learned about this word like a month ago, a warrant sniper. A warrant sniper is someone who gets in on a private placement, and as soon as the shares become available to them, they sell the shares and hang on to the warrants, right? I don't believe in that. I invest in a private placement because I've already invested in the company. And so I believe in holding the shares as long as possible, but I also want to get my money off the table. I want to be as risk averse as possible. So I have several levels of the point of no concern. The first one is recoup your initial investment in the private placement. So in the company I invested $1,000 in, it was my first one. I wasn't paying attention. The shares actually got to 26 cents before I figured it out. And I sold a little bit to recoup my $1,000, right? I sold just enough to recoup my $1,000. So PONC level 1, get your money back, as soon as you can, but not until it doubles at least, because you want to have half your shares remaining. And then as you exercise the warrants, and in this case, I paid $1,400 and I get the shares, I want to wait until the shares have gone up enough so I can recoup my warrant money. Right. So as soon as they went from 7 cents to 14 cents, right? Because I exercise them at 14 and I can pull them. If I sell them I exercise them at 7. If I sell them at 14 and I sell half my shares, I still have half my holdings. Plus I've recouped my investment. That's PONC level 2. I did it for the initial shares. Then I did it for the warrants. I've recouped my investment. I still have half my holdings. Those are now free shares. But now's the really critical part, because I've got my money back, but I haven't made any money yet, right? I'm sitting on some shares. technically in the bank, I have money, but I haven't got any profits yet because I haven't sold. So I put together the hold and exit strategy where I say, okay, my risk tolerance level is either 1.5, 2, 2.5, or 3. So let's do the extreme. Let's take 3. Well, that means I'm going to wait until the shares go up threefold. If they're 10 cents, they have to go to 30 before I sell. If I took a 5-level risk factor, I'd have to wait till they went to 50. So I need to decide what my risk factor is. So I like 2. Let's say my risk factor is 2. I'm going to wait until the shares double before I sell half. And that's what I call, after Tim Hortons double. I call it the Tim Hortons double half strategy, right? I wait till it doubles, I sell half. And so the hold and exit strategy forces you to keep selling at your risk level, which is I call it the Hes multiplier, right? I want to wait until my shares go at least twice. That's a Hes multiplier of 2. I want to wait till the shares go up at least 3 times. That's a Hes multiplier of 3. And when you pick that multiplier, you do the math, and it tells you when it gets to this price, you sell. It doesn't matter what else is going on in the world. It doesn't matter if they just discovered something, because you know what happens to these companies when they discover something, sometimes the stock price goes down. And you go, what? No, they had already priced in the discovery. People are taking their money now, So I wanted to get my money off the table as quickly as possible while still holding on to shares in companies that I believe in, hopefully with achieving PONC level 7, which is I've sold shares. I didn't wait for the top. I took profits, but I still have shares left in this company that I now might keep for the next 10 or 20 years because it's going to be a producing mine, or they're going to be producing helium, or they've got a great product which is the Kleenex of that industry sort of thing. They've established themselves now, and they're generating good money and they're paying dividends, right? I want to invest in these companies that are trying to build the economy and that eventually get transferred into dividend-paying companies. Mm-hmm. And then I'm sitting on a bunch of free shares of dividend-paying companies. And then still, if the company still does well 5 years down the road and their stock doubles again, I'm still going to sell half because I'm going to stick with the strategy. You take money off the table.
As I've heard you say before, nobody has ever lost money by taking profits, right?
Yeah, and where I got that was from a guy. There's a book I'd have to share. He's from Toronto, and he was in Bay Street during the 50s and 60s and 70s. And he wrote a book about mining. It's called Mining Bay Street, or Mining Profits, I think it's called. And he wrote this back in the 80s. And his core theme was nobody ever lost money selling. The key is to sell at the right time, which is usually when the stock is going up. But we all get greedy. We all get stupid. It's like deer in the headlights. When I'm deer hunting, and I'm sitting there in my stand with my crossbow, and I'm waiting, and the deer finally comes up. It could be the 12th deer I've seen. My heart still goes through the roof, and you get deer fever, buck fever, and your emotions take over, and I'm bad at that. And I'm like, in the book, I talk about how horrible doom scrolling is. Well, I talk about that to chastise myself because I find myself getting caught up in it, So you have to take the emotions out of it. That's one of the things I've tried to learn by watching your program and listening to folks like Rick Rule is I want to be a chameleon. I want to take from all of you the best of what you guys have learned and just do it, not question it, just do it, So you got to sell. You don't wait till it's at the top because nobody knows when the top is going to be there. And how many of us, I've got one stock in my portfolio now that, like my regular investments, that it went up and up and up and up. And I'm saying, this is a keep, I've got him for a long time. And 12 months later, is down in the dump again. I should have been taking money. Now I'm kicking myself for it, Well, with my private placement portfolio, which is a separate, investment portfolio, I'm applying rules to this, the Hes hold and exit strategy rules that I have never applied to my regular investments. Like, I invest in a balanced fund, just leave the money there, keep adding to it, forget about it. It's in my RRSP sort of thing. But with these guys, with this my speculative portfolio, I want to take a much different, more aggressive and more systematic approach. And so I documented that in the book because, again, I think there's a lot of people like me out there that are not investment gurus. They don't have an investment background. And they're going to get caught up in the emotions of, wow, I picked a winner, and hang on to it and hang on to it and hang on to it. And the next thing you know, it crashes and burns for a multitude of reasons, God only knows. So you want to take your money off the table, and you want to have a systematic and regular approach. I mentioned I had worked for Senator Joseph A. Sullivan when I was a kid on his private island. And that was one of the things he taught me when he took me out back to where the generator station was, because his little island had a separate generator station where he had a Coleman generator. And up on the wall, he had put a note there from him, and it had his name on it. And it said systematic and regularity. And he went through, there was a process that a checklist I had to go through each day, every time I did my rounds of the generator station, to make sure that I systematically and regularly checked off all the things I was supposed to check to do the proper maintenance. And so that systematic and regularity lent itself well when I got into the IT world, which I'm in, because it's amazing, how many people will do the same lab or try to implement the same software, but implement it 50,000 different ways, when it needs to be implemented in a very specific way to work properly and to be able to maintain and operate it, So I became a big fan of procedures. And when I got my pilot's license, it's all about checklists, And but believe it or not, checklists have saved my life twice in my airplane. On 2 occasions, I took my float plane in to have the oil changed. And when I got back to the seaplane base to get in the airplane to take off, I go through my checklist. And one of the things you always check is the oil. Well, these idiots on 2 occasions had changed the oil, but forgot to put more oil back in the plane. So had I taken off, I'd have gotten to about 200 feet, just enough that I would have very little control over the airplane to do a controlled descent. Most times people try to hold the airplane up, they stall it, the plane flips over and lands upside down, and everybody's killed. So checklists are important. It's taught me very, very clearly in those 2 cases. I mean, it would have been my life, or I would have ended up in pretty rough shape. So having a systematic approach to take the emotions out of things is so, so, so important. And I actually have some example tables that I use myself in tracking my stocks. My private placement investments. And I'm actually working on my own website now, where I'm going to be able to track my holdings of my private placements and all the information about it. And I'll be able to pull in data from Yahoo Finance, for example. So I'll be able to keep track of my own private placements in a portfolio management kind of system that is private placement friendly, effectively. And I'm hoping by the time I come out with book 2 next year, that I'll have a platform that other people that are interested in applying the PONC approach can actually log in, as a member and actually start using the same systematic and regular approach that I put in place in one location, or at least even do some practicing. And that's the other thing I talk about in the book. You don't have to get in this with your money right away. Open up a practice account. Pretend that you invested in that private placement. You pick that company, pretend you invested in the private placement. Do 1, 2, or 3 of those over a 6-month period, just to see and get a feel for it. You won't be able to get all the documentation like this. Well, that's not true. Generally speaking, you can get access to the subscription documents if you ask for them. Right? If you're not on the president's list, you say, and there are many, many examples of subscription offers out there. In fact, I have one in the appendix of the book, a whole subscription offer and what it looks like. And I highlight in it the main key points to look for it: the price of the special units, the restriction date, before I can put the private placement of the stock in my account, the exercise price of the warrants, the time frame of the warrant, like how long is it good for, and so on. So I show where to find the key information. And you can still practice. You don't have to, put your money in right away. You can practice a little bit. So I'm hoping to actually have that set up so that people could actually log in. I'll have a list of private placements there. They can pick the one that, for the company that they've decided, and just go through the motions so they can learn something. And that's what I did as well. I've had I'm not going to mention the company, but I've had a practice account at the investment bank that I'm with. And just to be clear here, I don't have a big trading account or anything like that. I don't use all kinds of fancy software. I use the same basic Canadian bank investment account, direct investment account that anybody else in the country or in the States can use. It's just your regular investment account. That's all it is. Nothing fancy. And they have a practice account feature on there that you could play with as well. Yeah.
Arnold, you mentioned that you want to be investing in these companies regardless of the private placement. So
yeah.
What kinds of things do you take into consideration that make a company worth investing to you?
Great question. So just to be clear, like I'm not a financial analyst, I'm not a geologist, I'm not a lawyer or anything like that. I'm an IT guy, and I'm a self-taught IT guy. I don't even have a computer systems engineering degree. I'm all self-taught. I studied photojournalism, right? So I came through, I got 30 years of IT experience now. So I'm self-taught in that regard, but I'm not an expert. So when I looked at these companies, I started to go out and watch your website. I watched a bunch of other ones. I followed Rick Rule, and I listened to what they talk about. And they talk about a couple key things. Who are the management, right? What's their track record? Have they been successful at this before? And in particular, if they were successful at doing diamond mining, they might not be successful at the current gold mining project that they're promoting, So, I mean, what's their background? What's their experience, and who are they? And that to me was communicated to me as one of the most important things to look at. And then the asset. Look at the resort. What's the asset they have? And that's either a mineral resource or a technology resource, because some of the companies I invest in are technology companies. I'm in one in particular right now that has a solution for data centers, and they're building data centers now faster than they're building hospitals. We need hospitals. They're building data centers. I mean, Microsoft or Google last year said they're going to build so many data centers in the next 5 years, they're going to use like 1,000 Eiffel Towers worth of steel. I mean, it's a growing industry, and COVID's made it grow even more. So I looked first to see what do the experts look at in these companies, and it's management, assets, and the third big thing is market cycle. Where is this company in the market cycle? That was something else that I was really taught to pay attention to. And it was one of the reasons that in the spring of 2020, I started to get into this, looking into spending $5,000 to speculate. To full transparency, I'm also a silver stacker. I stack silver, physical silver. And I like mining companies. I'm from Northern Ontario, so I have a bit of a bias there. I've actually traveled to a lot of mines when I worked for Champion Road Machinery. I delivered parts to mines. And so I've got a bit of that mine lure in me, if you will. So I look at the market cycle, and I thought, commodities is going to go. They've been in such a downward cycle for so long. We are going to come out of this stupid, COVID thing that we're all suffering through right now. And we're going to come out of it stronger people, a stronger human race, I think. And, there's going to be an increase in industrial demand, and things are going to go up. And certainly solar right now is all the rage, whether you think it's the right thing to do or not. Governments are going to go down that way. They're going to force us to go down that way. And so I see things like silver and copper being in huge demand going forward over the next 20 years, 30 years, And so that's partially why I started getting into the speculative thing. So the market cycle for me is the third big thing. And those are pretty much the things I look at. Now, I can't read a National Instrument 43-101 to save my life, other than to look at the grade and the size of the deposit. And those were two things that Rick Rule said, he really looks at is what's the grade and what's the size of the asset. And who are the management running it, and where are we in the market cycle? And so because I'm not a geologist, what I tend to do is I tend to look at a property, look at a company, look at their properties, look at the grade, look at the assets, look at the tier that they're in potentially, or the potential tier, the tier they have the potential to be in. And then I compare it to the greatest equivalent assets in the world. Look at the greatest gold mines, look at the greatest copper mines, and look at their grade and their assets and compare it to the project you're looking at. And if the comparables are there, that there's a chance. And if you got the right management, there's a chance that they're going to hit something and find something and make a good go of it and take it, as you know, mines, the people that start the process and the people that end up running the mine are usually two totally different groups of people. So you want management that are smart enough to know when to play the game at their level. So they know when to, step aside and let the big boys take in to bring it into production, for example. And I've seen a number of companies where you have owners and managers, management, stubborn as hell. They don't want to do that. They want to be there for the whole trip. And subsequently, the projects never take off, So management is really the key thing. So those are the three kind of things I look at. Would I invest in, say, the coal mining business today? Nah, probably not a good idea. The market cycle is kind of like, and so those are, for me, the three key things. And then I start to, I'll find 6 or 7 companies that I like, and then I'll winnow it down and I'll compare each one of them to each other. And then again to the, what is the excellent one out there. And I'll make a choice. And again, I'm small player, right? One of my biggest holdings out of the 12 right now, I think is, 15,000. The rest are all 5,000 here, 10,000 there, sort of thing. So it's not massive amounts of money. I mean, for some, it's a fortune. I know. And I'm not saying that disrespectfully. But for me, it was a small amount of money that I was prepared to lose. But I also know it's better than buying a lottery ticket. And it's better than me spending another $1,000 on that iPhone or Android that I don't need because I just got mine last year, So I'd rather take that money, sacrifice it, go without the new phone, go without the new, my truck is 2011. It's my third Dodge Ram. It's only got 117,000 clicks on it. If I want to buy a new one like that, it's the Bighorn. It's going to cost me 150,000. I just spent 5,000 on it, redid tie rods, tie rod ends, brakes, drums, all that sort of stuff, and it's like a new truck. I'd rather take that other $145,000 and put it somewhere else because that truck's going to last me another 5 years now. So, it's a bit of a way of life and how you want to approach what you do with your money, I guess, too.
Absolutely. So you shared with me a chart, as part of this market cycle idea.
Yeah.
You shared with me a chart about how the Dow still has quite a ways to go in a melt up phase to match the crash of 1929, and we can put it up for viewers here. So, kind of give us the history lesson that provides for us.
Well, yeah. So as you know, Patrick Karim, he's a bad charts, phenomenal chartist. He just has such he's a storyteller. He has such a way of taking these technical charts and explaining them in layman's terms that even I understood. I'm not a chartist, but I am a data analyst. I understand. One of my favorite books is How to Lie with Charts. If you do a lot of presentation with charts, you have to read that book, folks. It's in its 15th edition. And it's unbelievable what people can do with charts. But Patrick knows how to take those complex charts and actually explain them. So he and I have been bantering back and forth for a little while through email. And I really believed at that point. Now, this was last December 2020, I believe, is when I put that out. And I was convinced that the market was way oversold. I mean, it's just the euphoria these days, the FANG T and just the stocks going through the roof. And I won't even get into the money printing and all of that sort of stuff. I completely don't understand the relationships for it. But the stock market, when things go up, things have to come down. It's just history is not duplicated, but it sure rhymes, over time. And we will have a crash eventually. There is no question about that. It is a matter of time. So back in December, in my layman, very simpleton terms, I believed that the Dow was oversold. And so I pulled out the 1929 stock market crash chart and I compared it year by year to, where we are now. And much to my shock, and it changed my opinion, fortunately, and I am open to having my opinion changed, especially when I do it to myself. And that's what that chart did. It told me that, Arnold, we got another to go. I mean, I think the chart that I showed would show the Dow at like 45 or something like that. in order for it to be at the same level that it was at in the 1929 stock market crash. And I think when I noticed that in December 2020, I think the Dow was at 30, 32 or something like that. So I was quite shocked. And it said to me, the exuberance is nowhere near at the level, the current level of exuberance is nowhere near at the level it was in 1929.
Not yet.
Not yet.
Because we're only at like 34,000 today.
Exactly. So that gave me a whole other perspective. And Patrick and I talked about that for a bit. And my point to Patrick was how a simpleton with two charts overlaid one on top of the other, noting where things are currently, can actually discover something. And he thought it was quite fascinating too. That, relative to 29, we're still a long ways away from the top, folks, which to me is shocking. I still find it hard to believe and accept. But if you're a technical analysis, a chartist, or if you're into pattern recognition, which I'm into pattern recognition big time, that's what machine learning and artificial intelligence is all about. Things do cycle. And so, something will cause the next cycle to turn. Who knows what it is? Mm-hmm. So that's how I came across that. But it's part of my exercise in comparison, right? I'm not smart enough or trained enough or educated enough to know the technical details of that 43-101 document, but I can do comparison. Mm-hmm. And that's what I was doing in that example of the Dow, the comparison of the current and the 1929 Dows. And it's the same thing I do when I'm analyzing the companies that I want to invest in. I try to figure out what are the most important things we need to pay attention to for a mining company, for example. Mm-hmm. The asset, right? The asset. And the smartness of the people who are going to shepherd that project through its many phases to get it into production. Without those two things, the rest is, and even in a downward market cycle, if you've got a good company, its stock price is going to go down less than everything else will, mm-hmm. right? So again, that it goes to show or speaks to the importance of doing your homework, doing your research, picking a company for the fundamental reasons. And then, like Rick Rule says, when it doesn't answer the question and there's no longer a reason to have it in your portfolio, get rid of it, mm-hmm. right? Get rid Absolutely. Of it. Because if you don't get rid of it, then you get what we call the PONR, the PONR, which is the point of no return, which again, Rick Rule uses, mm-hmm. Which you're not making any money. Mm-hmm. Right. So take, for example, the PONC strategy I talked about, where PONC level 1, I recoup my initial investment. PONC level 2, I recoup my investment from the warrant. I haven't made any money yet. I've done a lot of work. I put money out. I put it at risk, but I still haven't made any money. And so that's where that execution of, taking your profits when you can is so important along the way, to have that due diligence. Because remember, if I got greedy and I waited and then it went back down and I hadn't taken money, then it becomes a PONR. It becomes a point of no return. And those are the ones you want to have on your scoreboard.
Absolutely. Of course, the name of the book again is Private Placement Profits, and you also have a website, privateplacementprofits.com, where you have a bit of a blog and a bit more about the book there.
The ice cream cartoon is there, mm-hmm. and I've got a guy right now working on taking the ice cream cartoon and making a video out of it to get the point across. And again, that the whole reason for the ice cream cartoon and the ice cream analogy was just as in a very simplistic way explain, the concept of the private placement and how you get the ice cream when you invest in the private placement, as opposed to just the cone, which is when you buy the shares off the public exchange. Mm-hmm. So the cartoon's there for those of you that want to see it.
Perfect. Anything else to add before we wrap up here, Arnold?
The last thing I would say is this, ladies and gentlemen: don't invest money that you can't afford to lose. Okay. These are not the blue chip, top 5 stocks on the Toronto Stock Exchange, or these are startup companies that have a lot of potential. And for young people, I would say, if you're young and you're really really willing to work at it a little bit, you can find some of these promising startup companies that are going to be the rock stars in 10 and 15 years from now. And if you were one of the ones that invested in it now, even if it was just $1,000 or $5,000 that you scrape together, those companies have the potential to become the Apples and the Googles of the future. Mm-hmm. And look where those people were that, invested in Apple and Google. So the stock market is a great way to grow your wealth, but, you have to you have to do your homework, but, don't invest in lottery tickets. I mean, that's a tax for the stupid. And take that money from the lottery ticket, delay your phone for a year, and do some research and get involved in these startup companies, because you're going to help them grow the economy. They're going to provide jobs, but you only do so with money you can afford to lose, because there is risk. So that would be the last thing I'd want to say, other than Tom, thank you very much. We had a great conversation before the interview. I really, really did enjoy that very much. And there's your program as a research program for me was instrumental. I've been watching it for a year now, and it's been instrumental in my education. So I do recommend, and it's recommended in my book as well. In fact, I quote you guys several times that, this is a great place for you to get what I consider to be fairly unbiased, well-researched information. And that's what you want, because there's a lot of sharks out there. I talk about it in the book. In fact, on YouTube, you might have seen it now. There's a couple of these channels. All they do is advertise private placements. Okay. All they do is advertise private placements. It's marketing. It's worthless. You don't buy a company just because it has a private placement. You buy a company because you believe in what the company is doing, and that takes time to research. Mm-hmm. So you can participate in this. And I think for millennials or younger people in particular, and I hate these classifications saying, oh, you're Gen X, you're millennial, you're an average investor. Don't get me started on that. I hate that term. So this is a great place to inform yourself. And it's been a very informative site for me as well. So keep up the good work, Tom.
Thanks, Arnold. I appreciate the vote of confidence and the support for the show. Absolutely appreciate your time as well. Thanks so much, Arnold.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.